everybody, it's Chris Buteau with Cleveland Street Mortgage, and today I want to talk again about adjustable rate mortgages. By the way, if you forget, it's on the hat. ARMs are very popular right now because interest rates are high, and when interest rates are high, people start looking for alternatives, and adjustable rate mortgages start to make sense. And the reason that they come into the marketplace at this time when rates are low, that doesn't really make a lot of sense. A lot of people want to fix those low, lock those low interest rates in for a long period of time, and they'll go for those 30-year fixed rates. And it's hard to make an adjustable rate mortgage low enough for that to make sense. But when rates are increasing like they are now, then an adjustable rate can make a lot of sense. And where this is particularly true is if you're in the market for a vacation home right now. There can be a substantial difference between the fixed rate price and the adjustable rate price on a 30-year fixed rate, on a vacation home financing right now. And the reason for that is Fannie and Freddie both implemented very significant price hits for second homes a little over a year ago, I think, or about a year ago, to make second home financing much more expensive than primary residence financing. But that doesn't necessarily apply to portfolio lenders. And so if you're borrowing from a portfolio lender and you're looking at an adjustable rate mortgage, for example, I priced out today, I compared an $800,000 purchase with 20% down, so that's a $640,000 loan amount, and I looked at 30-year fixed rate versus 5-year ARMs. And the difference was stark. I mean, the difference was the interest rate on the 30-year fixed rate was about 6.5. You could get lower than that. But with the first credible lender that I found in my universe of lenders out there, really the first one that I would rely on to get the deal done, you're looking at about 6.5% interest rate with no points. Whereas the same deal on a 5-year ARM was 4.875. So right away, very significant difference. The monthly payment difference, just to begin with on that, is going to be, let's see what we're looking at here. Bear with me for a sec, about $33.86 principal and interest versus $4,045. So upwards of $700 difference in the monthly payment, but the actual cost is significantly different. You're looking at a rate of 4.875 versus 6.5. That's, what is that, 1 5/8 difference in rate on a $640,000 loan over a 5-year fixed rate period on an ARM. So you have a 5-year ARM, and if you have that rate differential guaranteed for the first 5 years anyway, you're going to be about $52,000 ahead on the adjustable rate mortgage versus the fixed rate mortgage. And then adjustable rate mortgages have limits on how fast they can adjust. So let's say you assume the worst and the adjustable rate mortgage does adjust upwardly based upon what's happening with the economy. Cost of money is going up, and these mortgages are designed to go up with the cost of money, but they have limits. So this particular case, it's limited to 1% per year. And so I ran the numbers and just said, okay, let's say that worst case scenario, the indices are as bad as they can be. And so this adjustable rate mortgage is going to adjust the maximum amount it's allowed. It would take almost 9 years all in on this mortgage before that $52,000 guaranteed built-in savings is met by the increased cost because of the increased rate on the adjustable rate mortgage versus a fixed rate. So you see, you got a very long time before you'd even break even. And the average life of a loan is generally between 5 and 7 years. And so you're really, just playing the odds, you're definitely on the winning side of the odds if you go with an adjustable rate mortgage. Now that has risk. We've talked about that before. These aren't for everybody. Adjustable rate mortgages are only for people who have both the emotional or psychological risk tolerance and the financial risk tolerance. You have to be able to absorb increases down the road. If you're using an adjustable rate mortgage to get into a property that you couldn't otherwise qualify for if it was a fixed rate, that's a little bit of a red flag, because that means if it does adjust down the road and your income hasn't scaled up to match that, that could be a problem. But for those people who can tolerate that, who have the financial risk tolerance because they have cushion, from a strictly economical standpoint, it seems like a reasonable risk to take, especially when you're looking at financing a vacation home. The other thing I want to talk a little bit about is APR. What's up with APR on adjustable rate mortgages? We're all taught to look at APR and to compare APR That's kind of the holy grail of mortgage shopping, at least in the federal government's and the regulators' eyes. But it really is a very poor substitute for just simply looking at the cost and the interest rate, because APR assumes you're going to be in that loan for 30 years. And in an adjustable rate mortgage, you have a further assumption of what's that rate going to adjust to. And the assumption is based upon whatever the index plus the margin is today on that rate, not what it's going to adjust to in the future. And so it's very common to see adjustable rate mortgages quoted with an APR that's less than the starting note rate. And that's because based upon the current market, the index plus the margin, or what they call the fully indexed rate, may be lower than what they're offering you, but that index is designed to go up over time if the cost of money goes up over time, and that's the risk that the bank is hedging by offering you that that index, and so that adjustable rate. So you can't really use APR very effectively to compare a 30-year fixed rate mortgage versus a 5-year ARM, because they're calculated very differently, and it doesn't really tell you anything very useful about that. What's better to understand is just, okay, what are the costs? One-time costs, the closing costs going into the loan, fixed versus ARM, and then what's the interest rate delta between the fixed versus the ARM, then how long will that delta exist, or how long is it guaranteed to exist? If it's a 5-year ARM, that rate's guaranteed for 5 years. And then from there you can start to do the math with assumptions about, okay, now what if things go really poorly? How long will it be until this ARM was a bad idea? And how long will I be in that mortgage? So anyway, that's all I got for you today. Thanks so much.